Hello, everyone. Today on the final bar, we'll talk about the market in full on distribution mode. Friday, we saw weakness going into the close. We addressed the 50-day moving average. We talked about scenarios for follow through this week and what to look for. If you were looking for downside confirmation, I think today certainly has given it to you. A nice bounce going into the close, but overall, the damage has been done with the S&P around 4360. Also, a good amount of distribution in cryptos. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets using the power of stock charts, using data visualization techniques to quantify investor sentiment, investor psychology, and focused on the key messages that price, trend, momentum, breadth, sentiment, all of the above and more can provide us to understand what is happening underneath the hood of the markets. We talked in recent weeks, if not recent months, if not much of this year, about the potential for distribution phase, what it could potentially look like. Now, we really haven't had a severe down move in quite a while, and the pullbacks that we have had have been fairly limited in scope. We talked last week and in recent weeks about some of the levels to look for, some of the key levels that you'd want to see hold as long to confirm that the bull market phase is over. We talked about some of the lines in the sand for particular indications to indicate whether the bull market phase had ended. I would argue some of those have been triggered Friday into today. We're going to look at some of the evidence on the chart of the S&P 500, also elsewhere. And I think when you think about equity investing, the good news is it's not just about the indexes; it's also about a lot of the individual names. And I think when you look at the individual stocks today, you'll find plenty of distribution, short term, but also triggering some longer term signals. We're going to look at as many of those as we can. Great show today coming up where we hit the market from three directions: top down, bottom up, and sector rotation. We have great guests coming up this week, by the way. Tomorrow on the 21st, Tony Zhang from Options Play. On Wednesday, the 22nd, Jay Pettit from Charts Avenue. And then on Thursday, the 23rd, Katie Stockton from Fairlead Strategies. Coming up the week after, on September 28th, on Tuesday, we have Alessio Ritigliano. He's a Wyckoff expert focusing on cryptocurrencies. Should be very interesting to hear how he's applying that toolkit to the crypto space. Also, just a quick heads up, the next episode of The Pitch, which is our monthly stock charting showdown, if you will, featuring three guest experts, is coming up September 28th. We're excited to share with you latest opportunity to have three experts weigh in on their stock picks. Let's continue on with today's show with our market recap. So again, Monday's show has three phases. First off is where we're at now, which is the top-down macro portion. Let's talk about the big picture and how that big picture has evolved. If you caught Friday's show, we talked in a good amount of detail about the chart of the S&P 500, and with recent guests, people like Frank Capilleri last Thursday. We talked about the S&P and some of the key levels. And many of our discussions have focused on the 50-day moving average and the importance of that as a trend-following mechanism for this market. That has been blown out of the water, I think, today with a huge sell-off through those levels. Again, you always look to see follow-through, and I think if you saw the close at the level on Friday, today was certainly follow-through to the downside with plenty of distribution really across the board. Now, certain sectors like utilities held up okay, and we're going to look at those charts here in a few moments. And certain groups, by the way, things like airlines actually had a decent day bouncing higher, but those are not the leading stocks. Those are not the best charts out there if you look at the long-term trends. So what was the damage today? The S&P finished down about 1.7%. It was down a little further there just after 3 p.m. Eastern. A nice rally into the close, but still closed around 4360, just below that. The NASDAQ 100 down a little bit more, the NASDAQ composite as well. Mid caps and small caps, sort of a barbell around the S&P with the S&P in the middle. Small caps leading the way lower, down just under 2%. The VIX has spiked much higher to 25. We'll try to get to that if I can remember to do so here momentarily after we go through some of the other asset classes. Very quickly, interest rates down today pretty big. So there's a movement away from stocks into bonds. That stock to bond ratio has certainly been favoring stocks for quite some time. You had a bit of a change to that in recent months, but then in the last month or two, you've seen a rotation back favoring stocks. It's going to change a bit on a day like today. It's going to take more than one day to really evolve that trend from favoring stocks, but it's certainly a ratio to be looking at, especially if you're an allocator and you're thinking about that ratio of risks and non-risk assets, essentially. But a bit of a flight to safety today, with the 10-year yield going down and ending the day around 131. The dollar index was essentially flat, so the dollar was not a real player today. Looking at the different asset classes, gold was one of the few commodities in the green today, by the way, with the GLD up 0.7%. Pretty much everything else was down. So gold and silver had kind of a mixed day today, and overall, broadly speaking, commodities were lower, and energy was the worst of the 11 S&P sectors today. If you enjoy the color red, you will very much enjoy the crypto market recap or the market overview page, where a lot of these are down 7 to 10+%. Bitcoin and Ethereum down in the 7 to 8% range. Now, again, that's coming from Sunday's close, right? These are 24-hour and they trade over the weekend. A little, obviously lighter volume over the weekend. Let's look at a chart of cryptocurrencies, and in particular Bitcoin here, just to start off with. Then we'll look at the S&P, we'll look at the VIX, and then we'll see what else we have some time for. So when you look at the chart of Bitcoin, again, over the weekend, it was a bit sort of sort of chopping around that 48,000 level. Now, again, this looks like a relatively compressed range, and it is, but just remember, given the volatility in cryptocurrencies, these are pretty significant swings day to day. These are not small movements, although the chart looks like a very orderly trend. You have to remember, this is going from 10,000 up to 64,000 and then down to 30. So these are pretty big, significant price swing. So while the trend toolkit, I think, works very well, while I think the lessons of momentum and so forth work incredibly well, particularly looking at something like RSI, let's remember that these are, career-busting moves in these short-term swings in cryptocurrencies. It's certainly a volatile asset class. What's happened now since Friday, when we looked at or late last week when we looked at this chart last, is now, given the distribution you're seeing today, you're now establishing the high over the weekend as a lower high, right? So you have this pattern of higher highs July into August into early September, and breaking above 50,000 certainly felt like a follow through to the upside, regaining or a strong potential to regain those all time highs to the upper 50s, lower 60s. We gave that back, and we sort of had a big down day here, going back below 50,000, and also getting down to the 200-day moving average. We then traded back above it to find resistance around 48. Now we're once again testing this pink shaded area, and this has been a pretty important area. This 42 to 44,000 has served as resistance. It's served as support. It's a Fibonacci level. It's price support and resistance, pretty key one. And now we're back in that range. So I think that thesis remains the same. Remaining above that or holding that would be key. If we would break much lower, though, you have the potential to call this a weird shaped head and shoulders like pattern, but I think still qualifies as a high surrounded by lower highs, and breaking the neckline, which we're potentially doing. We're actually right at the neckline today, but breaking much further, breaking below 42,000, I would say really completes that and indicates further weakness. So certainly, given the distribution you saw today, picking out some of those key levels and focusing, I think we're still within the realm of things are okay given the overall trajectory, but very, very close to a breakdown that would indicate a high likelihood of further retracement. At the chart of the S&P, let's spend a minute here, and then we'll have to move on. We've talked in recent weeks about the four steps, the four things to look for. Number one, breaking the 50-day moving average. We closed below that, for maybe the fifth time this year, fourth or fifth time, glancing back on I think it was a fifth time for the year. On Friday, we've now followed through to the downside in a pretty major way. I think the 50-day moving average now has been broken. Step two, do we hold the August lows? And we're just closing below that today, with the gap on the open to 4,400, the move lower below that support level. We're now potentially breaking that down. I would need to see a follow-through day tomorrow to confirm that breakdown, to indicate that. But that would be the second point. The third point would be a lower high, which we've not had that. We rally at some point from this distribution. The question is, do we regain the previous highs? And does the RSI hold 40, which I would argue with today's sell-off, we do not. So this is the lowest the RSI has been the entire year. So 2 out of those 4 have broken. One of those, the third item, is potentially broken. We wait for confirmation tomorrow. And then the fourth one might be the final thing, which would be a lower high. But overall, I think today really confirming that move to the downside. I think you have to start thinking more about risk assessment and thinking more about potential for downside. When we look at some of the individual charts, stock charts here in a little bit, you'll see what I'm getting at. Just finally, then, but we really have to get on to to the sector look. We want to look at the VIX very quickly. Again, we talked about the VIX in that 20 to 22 range. We've hit that a number of times. The garden variety pullback was a pullback to the 50-day moving average. The VIX just above 20. That's a buyable dip. We've now blown that out, and now we're looking a lot more like May's pullback at least, right? At least something like that. Now, that ended up not being much further. We sort of chopped around for another week. We set sort of a level of support and didn't undercut it, and then the uptrend resumed. And I think that's what you'd be looking for, is seeing if we're able to establish some support and then hold it again. That the VIX getting above 20, and I think following through to the upside sort of changes. It's a change of character at the very least. Let's continue on with our second phase of the day, looking at sector setups. We've talked about the big picture. Let's look at the 11 S&P sectors, how they are all revolving around the benchmark. We'll start with the RRG. This is Julius de Kempener's design from many years ago. We're super fortunate to have on StockCharts a very elegant way of illustrating the 11 S&P sectors and how they rotate around the benchmark here in the middle. If you don't understand this visualization, we don't have enough time really to go into the details here, but look up Julius de Kempener's show called Sector Spotlight. He does a great job of describing this methodology in a little more detail. But what we're seeing, where are the pockets of strength? Well, the strongest sectors are the one furthest to the right. This is using weekly data, so it's a little more of a longer term look. And I think, to be honest with you, on distribution days like today, it's a really good idea to take a step back. It's very easy to get caught up in the narrative of the short term sell offs. And don't get me wrong, some of these stocks are certainly at risk of breaking significant levels or following through on downtrends that have already been established, to be honest with you. But looking at the big picture helps you understand the overall trajectory of these charts and how they're evolving. And when you think about the weekly data, you see three sectors that are really the outliers to the right: technology, healthcare, real estate. The challenge with those three sectors right now is none of them are really going in the direction of improvement, right? Northeast, which would be a strong trend or an improving trend that's continuing to show increasing positive momentum. Real estate is flat out heading southwest, which is the direction of deterioration. This is a weakening relative trend. You have technology and healthcare, while still okay, they're just kind of more going straight down to southeast. That's not horrible. It's not broken, but it's just not improving anymore. It's sort of stable, but not really gaining any ground. And then you have things like utilities, which had been improving and are now rotating down in the downward direction, the southerly direction. Interesting to see some of the cyclical sectors actually starting to improve. Financials in particular, when we're looking at a lot of the individual names, I think some of them are certainly in pullback mode. Things like BlackRock and Northern Trust come to mind. We'll try to look at those if we can. But some of these are really showing a change of character, showing a rotation below key support levels. And I think that's the danger for any of these sectors. It's worth noting why the RRG is so helpful in an environment like this, where it feels like all the charts are rotating lower, and not all of them are. Again, things like airlines are holding up, gambling stocks are holding up. Certain ones are doing okay today, but the average chart is certainly deteriorating. In recent weeks, or certainly Friday into today. This is where relative strength is crucial, I would argue. And on the institutional side, this is where I think, earned a lot of the value of active management, was getting out of things that were not working, recognizing that trends were broken, and going into things that were outperforming. And a lot of times in this sort of environment, you look for some of the defensive sectors, things like consumer staples, things like utilities, things like real estate. This would be the opportunity for them to really outperform as they hold up, as people fly to the safer parts of the equity markets and get out of the more speculative areas. So sectors like that you might have been ignoring, particularly consumer staples, could be worth a look here to see if some of these stocks start to really outperform. And while they may not be your favorite charts in history, they could be higher dividend payers that allow you to ride out periods of uncertainty, have an income component. And again, a lot of these are going to hold up on a price basis as well. Let's look at the 11 S&P sectors using the candle glance page. Now is, use the analogy of having a bunch of, charts printed out and throwing them on a table, and just sort of seeing what patterns jump out at you, sort of grouping charts and grouping ETFs by particular patterns, particular breakouts or breakdowns, what looks similar, what doesn't, what are the outliers. And this candle glance function can be a great way to do that. Take a chart list and then look at all of them together. And what you like to do, or what I like to do in this situation, is just sort of glance around and see what general themes we can pick out. How many of the 11 S&P sectors are above their 50-day moving average? Unfortunately, given today's distribution, the answer to that question is zero. So if you're wondering how much distribution we're seeing today and what that means relative to the big picture, you're seeing breakdowns across the board. All 11 sectors are coming off today. to varying degrees, but all 11 of them are now below the 50-day moving average. So, given some further dislocation, you have to start looking at the 200-day moving average. A couple of them are either at their 200-day or just at risk of breaking down. Energy is number one, industrials number two, materials number three. So it's certainly the cyclical sectors. We've talked about the weakness in some of these sectors up until today. So while the severity of the drop certainly is significant, the fact that the sectors have been underperforming should not be a surprise that these are the stocks that are struggling to hold a key moving average like the 200 days. Something like materials, I think, is a great illustration of the challenge for a lot of the stocks in that sector. We've established a lower high, which is not overall positive. We've been underperforming, which is not positive. We're making a new 12-month relative low. None of those things are good. So, what is encouraging? Well, at this point, we're holding the 200-day moving average. We're right there as of today's close. We're also holding the July low. You see stocks and ETFs like this breaking the 200-day and following through, unable to hold the recent low from the last couple months and following through to the downside. A chart like the XLB is very close to looking incredibly negative as it follows through on the downside momentum you saw Friday into today. Industrials, very similar picture, holding the 200-day right at previous support levels. So, what about some of the leadership sectors? Communication services comes to mind. While this chart overall is not horrible, again, I'm going back to my conversation with Frank Capillari, I think on Friday or Thursday, where we're talking about basically the XLC is the market, the correlation or the relationship between the XLC chart and the S&P 500 chart. They're almost identical, right? Holding inconsistent uptrends, holding the 50-day moving average consistently. They've both failed to do so as of today, right? The XLC, again, testing previous swing lows, right? And so I think this is the time. The natural tendency, which I think is very appropriate, is now that we are not making new highs for the most part, we're now pulling back within the range. This is when things like Fibonacci retracements, support and resistance levels, moving averages become vital, because this is what helps you differentiate which stocks are holding key levels and which are not. And in general, stay with the stocks, stay with the names, stay with the relative safety of the stocks that are able to hold up while others are deteriorating. When we come back from the break, we'll look at some of the individual stocks that may be fitting that criteria and may which not be. We'll be back here in just a minute with Shifting Stocks. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we focus on the charts together and see how these trends are evolving. Again, quite the distribution day today, and we'll try to unpack as many of those charts together as we can here in our next segment. Couple quick announcements before we get there. First off, we love to hear from you. Feedback on your hosts like myself and many others. We love to get feedback on how we could do these shows better to add more value to you. Feedback on our guests, feedback on the content that we're showing, but especially questions that come up as you're analyzing your own charts. Let us help you answer questions about technical indicators, about market history, market dynamics, sentiment, breadth, whatever it is. We can point you in the right direction. The best way to get your questions to us is via email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Just put a comment below the video you're watching on our Stock Charts channel. We would love to hear from you and hope to answer one of your questions on our next mailbag show on our next mailbag on Tuesday's show this week. Also, go to StockChartsTV.com. You can use your email address, set up a free account, start watching all of our great content immediately from our website, also from your mobile devices. Just search on any of the app stores for Stock Charts TV on demand. Our final segment today is called Shifting Stocks. This is where we focus on the individual names. So we started big picture, talked about this, overall distribution phase that has been in play, but really sort of following through today. What does that mean for the overall trend? We look at sectors and saw which sectors were breaking down through their 50-day, now threatening their 200-day. Which ones were holding up a little bit better? And again, focus on the relative strength as much as possible would be my suggestion to you. Finally, now let's look at individual stocks and what sort of themes we can unpack. We'll start with the FANG stocks because, I think one of the reasons, if not the reason why the market has held up overall year to date in many ways is the resiliency of the FanMag stocks, really, those six names. And there are others in that sort of bucket, but it's the Facebook, Amazon, Netflixy types of stocks and how they've been able to hold up pretty well. Now, What you're finding, and as we look at a couple of these, you'll see that it is not a completely homogenous group, meaning they are not all one chart, right? The chart of Facebook looks a little different than the chart of Netflix or Amazon. Some of these are still within established uptrends, I would argue. Some of them are really starting to show something different. And really, a chart like Amazon is more range bound than everything. It's really a question of a failed breakout and not really a consistent uptrend. So I think you have some of these that are more consistent uptrends. Facebook has certainly been one of them, continuing to make higher highs and higher lows. Even with today's distribution, you've continued that pattern of higher highs and higher lows. And again, Charles Dow's theory of how you reverse a trend, or when you confirm that a trend is no longer in place, is you stop making higher highs and higher lows, you start making lower lows and lower highs. So that's why on a lot of these charts, I think it's most important to look at the final bar, right? The current bar. Look to the left and see where we're at relative to key support levels, especially these things that are pulling back, breaking the 50-day, which again overall is not ideal. Are they able to hold those recent swing lows? And Facebook right now, the recent swing low around 350. That's the low from mid-August, very close to the low from early August. We're sort of right there, right? We've traded down to that level, so we're still within an uptrend. If these sorts of charts go from still in an uptrend to now in a downtrend by making lower lows, by rallying and making a lower high, then the whole character of the market starts to change. And I think you need to look further on the S&P chart, down to the further support levels on the earlier chart of the S&P. We had some of those levels notated on there. Some of the levels of support that have come back from months and months ago. So Facebook overall, holding up pretty well. Charts like Alphabet and others are still, again, holding up okay. Alphabet is actually one that's still holding its 50-day moving average. Outperformed today by a little bit, only down 1.5%, while the market itself was down a little bit further. Seeing if these stocks are able to hold will be significant. And a distribution phase like we're arguably in now can be very widespread. It can also be relatively narrow, right? There could be certain pockets that hold up just fine. And looking to see if some of these are able to hold their recent levels would be key. Now compare those two charts, Facebook and Alphabet, versus the chart like Amazon. You get when I say that the Fang stocks are not homogenous. I'm thinking of Amazon as a great example. Amazon gave us plenty of indications that this uptrend, this resilient uptrend, was starting to sputter. And I think back here in July was a great example of that. You had charts like Amazon, Apple breaking out of bases, resolving patterns to the upside. This break higher on Amazon should have been an indication of Amazon essentially going to the moon, or at the very least doubling the height of this pattern and going much further, going into the 4,000s and really following through to the upside. We had a failed breakout though, right? We broke out. We didn't get much further than that breakout level, and then we started to retrace and we made a lower low. I'm sorry, a lower high, and then gapped lower. And so overall, the chart of Amazon has gone literally nowhere on a directional basis for the last 12 months. Amazon is pretty much where it was 12 months ago. So while you've had plenty of movement, you've had plenty of stocks in uptrend, it has not been everything together. And charts like Amazon still are not giving you any indication that they are great places to be, particularly on a relative basis. You look at the relative strength line, which has been in a consistent downtrend for the last 12 months. And Netflix is another one that's sort of in that camp, sort of where Amazon was not too long ago. That July breakout that ended up being a failed breakout, we're potentially getting that now with Netflix. This is a stock that rotated higher, getting above 600 certainly seems like a great follow through to the upside after making a higher low there July into August. All of a sudden, we're retracing that a little bit, coming back into that range. And again, it sort of looks like a sideways trend, right? An uptrend that has not really seen the follow through, a breakout that did not really see the follow through. What other charts can we look at within the energy sector? Now, this is a sector that's been underperforming overall. It's been one of the worst sectors recently, as others have shown signs of strength. A lot of the cyclical sectors have certainly been struggling, but energy's probably been one of the worst. And you had charts like Oxy, which made a high in March, retested the high in June. At this point, this is when the sector's really starting to look like it could break out and show a lot of strength from here. It's then shown this retracing pattern of lower lows and undercutting the 200-day, not ideal, making a lower high, not ideal. We had rallied back up and just gotten back above the 200, back above the 50-day for Occidental. Now it's starting to roll over a little bit, and so the challenge with this is it's starting to be sort of maybe a double topping pattern. This is maybe the double top March and July, and now we're following through there. This could be more of a head and shoulders top, depending on how you want to draw the patterns and how you interpret this particular price pattern. But coming off of the breakdown that failed, we came back up. The question is, are we able to hold those levels on the way back down if we'd further distribute. It's worth noting that on Oxy, some of the other energy stocks, the RSI failed just right at 60, which is more characteristic of bear phases than bull phases. Now, within that sector, you also have things like Valero and Chevron and others. I would argue these are still more in established downtrends, while Oxy and others had rotated higher and started to make you believe a little bit that they were starting to recover. Things like Valero have really not ever gotten back above there, still making lower highs, failing at moving averages, and rolling over the 60 level on a lot of these charts. A lot of the energy charts have really, I think, explicit support levels that are pretty easy to pick off the chart. 60 on Valero makes a lot of sense to me. Now, what charts were actually working? So within the industrial sector, airlines. So airlines, one of the better groups today out of all 105, 106 industry groups that we track. The challenge I have with the chart of Delta Airlines is just not a great chart. If you look at the long-term chart, it's just not great. So I'm always interested to see stocks that are holding up. And if you look at the leading groups today, it's things like airlines, it's the travel names, gambling, things like that are bouncing up okay. Some hotels are holding up okay. But again, this is just this little bar right here. So it didn't break down while everything else did, but it's still not a great chart. These are not charts that are in recovery mode. I would argue they're still in distribution mode, right? These are ones that have not made a higher high in quite a while, since back here in February to March. They're bouncing off of support levels, which is encouraging. So I could see the argument in buying relative weakness and playing a move back higher, but they're really not following through yet. A day like today, you'd have to see further upside, further signs of accumulation, I think, to get excited about the uptrend potential on something like airlines. Finally, when I'm looking at technology, I would say the two areas where I'm finding a lot of things holding up. In industrials, you're seeing some things working out. In healthcare, you're seeing a lot of relative winners, things like Danaher and Tech and HCA. So I'd point you to those names. With things like semiconductors, just a great reminder of the importance of resistance. You had resistance in April, resistance in June, resistance in July, resistance in August. Now we've had resistance once again in September. So when we talk about the importance of support and resistance levels, I hope Applied Materials is a good print it out and put it on your wall type of chart. It helps remind you why support and resistance levels tend to persist, why they're important to pay attention to. Stocks like this are not a great option until it's able to get above resistance around 145. That's all the time we have for that. We need to wrap the show. Go to the 3 and 3, three charts in 3 minutes. Here we go. Chart number one is the advances decliners by my read, and it's still sort of shuffling the closing price data as we're recording, as we're running the show today. But overall, looked like about 85% of stocks declined today. As decliners well over advances by about a 5-to-1 plus ratio. And so I think recognizing the fact that this was broad distribution is important. Days like this are concerning. If you look, this has been previous pullbacks where you've had a day like this, clusters of day like this, it starts to look more like September and October of last year, where you had broad distribution days, not just one-off days, which is what we saw back here in July, which is what we saw in May, where there were pullbacks, and then those were buyable pullbacks as we rotated higher. Clusters of 80+% down days are what you want to worry about, and that's what I'd be looking for in the remainder of this week. There are charts that are holding up okay, but there are ones that are not. And I think looking at the FanMag stocks, this is one of the charts that we reviewed many times, starting to differentiate. There is not a homogeneous group. Some of the charts are actually working very well. Charts like Alphabet, I think, are still nowhere near broken. They're still okay. Charts like Microsoft still holding their 50-day moving average and doing just fine. Charts like Amazon show a market that is really directionless. If you're a chart that is more directionless, right? There are stocks that really aren't gaining a whole lot, particularly on a relative basis. And I would be, focusing on the charts, especially that are gaining on a relative basis. That leads me to our third chart, which is Procter & Gamble. I struggle to highlight this chart only because on a pure absolute basis, it's okay, right? It's not bad. Down about 1% today, so not as much as the overall market, right at the 50-day moving average. That's not bad. The challenge is really haven't gotten a lot of relative gains on a chart like Procter & Gamble, even though it's round tripped from the October peak down to the low around 120 in March of this year, and then back up to the mid 140s. What's interesting about a chart like this, particularly if the market keeps deteriorating, is that the relative strength line can go higher. If the market keeps going lower and it feels like you're unable to find good ideas of good based on good charts, look at the relative lines and look for the relative safety of stocks that are outperforming. Folks, that is our show. Thanks so much for coming on this journey with us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.